Well, good morning and welcome to the program, ladies and gentlemen. My name is Joel Garris, and for the next hour here on News Radio 93.1, 540 AM, it's Dollars and Cents, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. We have a packed show as usual. We're going to talk about a phenomenon that happened this past week that is a little different than the phenomenon that the mainstream media is talking about. We're hearing a lot about the inverted yield curve, but today we're going to talk about the inverted yield of the Treasury bond versus the dividend yield in the stock market. That also inverted this past week, and we've got some interesting commentary on that, along with some suggestions of some things you should be saving money for now to better prepare yourself for the future. And we'll also start a conversation that hopefully won't get too political. We're really trying to abstain from that on the program. But it is imperative that we start to dissect some of the proposals that are floating around as we get closer to the election. So we're going to break down some of the proposals on the Democratic side of things in terms of how they would affect your taxes. There's a couple of these proposals that would have a pretty big impact, particularly when you inherit money. And we're not just talking about some of the legislation that's pending in Washington right now under the Secure Act that would eliminate the stretch IRA concept, but there is, in fact, many other proposals on the table. And so we wanted to chat a little bit about that as well. Also, give you some perspective on the spate of volatility. You often hear when the market has some level of volatility, again, the mainstream media loves to talk about it and say, oh my goodness, we've never had this much volatility. Well, at the end of the day, it's all relative. And when you look at the volatility over the course of the past 30, 40 years, you'll find very quickly that, in fact, the current environment is sort of normal. And when you look at the overall volatility of the market. So those are the things that we're going to hit on today's topic. So let's start digging into the material, if you will. We'll start first with this conversation about the inversion of bond yields to dividend yields. And the mainstream media has been fixated on the inverted yield curve. And if you look back on any of our social media channels, whether it be Facebook or YouTube or Twitter or even our website at nelsonfinancialplanning.com, you know that a couple of weeks ago we talked a lot about the inverted yield curve and what it meant and sort of explain that in terms of a concept. For those of you that missed it, we'll summarize it real quick. An inverted yield curve happens when the yield on a shorter term debt, or specifically a treasury debt, winds up going to be a little bit higher than what the yield is on a longer term treasury. And so consequently, if you think of it as sort of the chart should normally look like a gradually ascending hill, when it inverts, you sort of have a situation where the front part of the hill jumps up and it's relatively level and maybe a little bit higher than what the back end of the hill looks like. That's your inverted yield curve. And the thing that gets people's attention about that is the message that it's saying is that there is fear in the bond market to the extent where folks are more concerned about a shorter term repayment period of time than they are a longer repayment period of time. And so what that means is that basically folks want to be paid more if they're loaning money over a shorter period of time than over a longer period of time. And so consequently, that's what inverts the yield curve. So the media has been hashing that one to no end. And certainly we've spent time here on the program talking about that as well. But what we wanted to talk about today is something that you may not be hearing about, and that's the inversion of bond yields to dividend yields. And that also is a pretty rare phenomenon and has some pretty significant investment implications for you. So what we're talking about is the inversion of the bond yield on the longer-term U.S. Treasury to the dividend yield on the broad-based market as measured by the S&P 500. And so this past week, we actually saw those invert, meaning that the dividend yield, what you can expect to receive from corporate America on a regular basis in terms of the dividend payout, in fact, is higher than what you can expect to receive as your interest payment on your longer-term Treasury. And so what's fascinating about that is that is basically saying if you're looking for income, then you're actually going to get more income by owning a stock portfolio than you are a portfolio of long-term government bonds. So from an investment perspective, if you're looking for income, then you have to also make sure that you still have a healthy portion of your overall investment allocation on the stock side, because what that inversion of bond yield to dividend yield is telling us is that interest rates have gone so far down that you're not able to really get much of a return in terms of that interest rate if you're heavy on the bond side. And in fact, corporate America is paying dividends at a greater rate than what you would get by having an interest payment on a Treasury bond. So a fascinating phenomenon, one that certainly does not happen very often either, and certainly happened this past week when you look at dividend yield versus yield on Treasury. What's even more interesting about that inversion of bond yield versus dividend yield is that bond interest is taxed at a higher rate than what dividends are taxed at today. Dividends today are subject to a preferential rate in terms of what they are taxed at, and the highest dividend rate is at 15%, and then in the lower tax brackets, it's actually at zero. Now, in the ultra high income brackets, your dividends long-term capital gains rate can go to 20%, but for the most part, it's at 15 or it's at zero. Meanwhile, interest on a bond is taxed as ordinary income. That's subject to whatever marginal tax bracket you're in, whether that be 22% or all the way up to 35%. So if you look at this inversion between long-term bond yields and dividend yields, what you'll actually find on an after-tax basis is an even wider gap. Again, the investment implications for that is that you've really got to continue to own, despite the volatility that comes with the stock market, you've really got to continue to own a portfolio that has an allocation on the stock side, a pretty heavy allocation on the stock side, in order to continue to maintain the returns and the income, especially with this inversion of yield versus dividend that's happening, in order to have a successful retirement. We'll talk more about this, plus much more on the program when we get back from the break. You're listening to Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and we're on News Radio 93.1 WFLA. Howdy, folks. Welcome back to the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning. In the first part of the show, we were talking a little bit about a phenomenon that's, in fact, rarer than an inverted yield curve, and that's the phenomenon when long-term bond yields actually dip below the current dividend yield in the broad-based market. It happened this past week. First time it's happened, the only other time it has happened, in fact, was back in 2009, the start of this economic recovery post-2008. So certainly an interesting phenomenon when you think about it in terms of the investment implications. Dividends are paying at a higher rate from corporate America than the interest on a United States Treasury, combined with the fact that dividends are taxed at a much lower rate than interest from a Treasury. And my goodness, talk about a season in time where you really need to make sure that you're not getting shifted too much on the bond side of things in reaction to the fear in the headlines that is always so pervasive out there. You know, one of the things that I'm always fascinated about how often I hear this is that people have a tendency to think that the current situation is the worst, or the current situation is unique, or the current situation has never happened before. And what's interesting about that is, chances are, if you look through history, it may not be exactly the same, but there's certainly a lot of similarities. And so when you start to then look at the data on things, particularly if you think about it in terms of volatility. So certainly volatility here for the month of August has certainly increased versus what it was for the first few months of the year. One of the traditional measures of volatility is something called the Vix Index, and it tracks volatility. But basically, think of volatility as this: the days on which the market is swinging up or down by more than 1%. So normally what you'll find is that the market really doesn't move much on any given day. It stays kind of within a range and isn't too terribly exciting. But on other days, you'll see where it'll move either up or down by more than 1%. And generally, those days are considered to be, obviously, more volatile and helps to drive up the volatility. So when you look at the frequency of those days during the course of a calendar year, that's one way to similarly measure volatility. The other one is the traditional Vix Index. We've got a couple of charts that we'll put up on Facebook. For those of us that are looking at the video that we'll have on YouTube, I'm holding up a little bit of a chart of one of the volatility measurements and graphs here on for our video audience. And what you'll find is the little dotted line, and again, we'll put this up on Facebook so you can reference it. The little dotted line is sort of the average level of volatility in the markets going back over the course of the past 30 years. And what you'll find is the current volatility sort of about average. So some interesting numbers when you actually start to look at it and compare. Obviously, you see this big blue spike here. That's 2008, right? A lot of volatility during the course of 2008. So when you kind of look at the data and you look at it in comparison to the sort of those levels of volatility over the course of the past 30 years, what you'll find is that you're about average in terms of what the current level of volatility is. So we'll post the graph that we just showed our video audience, and we'll also post another one that breaks it down by the number of days each year. I think both of them are certainly instructive in the fact that volatility is very much a normal part of the overall markets. Remember, volatility has both sides of the equation. We often think about volatility on the downside. The reality is that volatility certainly also explains when the market is going up a lot as well. So volatility doesn't necessarily mean that it's going down. It also means that it's going up or down, and that's sort of how that gets measured. But some interesting perspective when you start to look at the numbers over time in terms of how much the volatility is today versus what it is on a historical basis. You'll find that it's about average if you look at the numbers. So how many more months do we have until this fabulous presidential election is over? I guess about 14, maybe 15 months, right? So I think it's important to start to talk about some of the proposals that are being talked about and how they could potentially affect your money. Let's recap sort of where current law is, and then we'll start to dig into some of the proposals that are on the table through some of the Democratic candidates that are out there in terms of what they've put forth as some of their proposals. So one of the things that has always been a factor in how people inherit money is this notion of a step up in basis when somebody passes away. And what that means is, if you think of this example, let's say 40 years ago, you bought ExxonMobil stock, and ExxonMobil was at $10 a share. And today, it's at $100 a share. So in that, you have a $90 a share gain. So if you were to sell that now, then you'd have to report the $90 and you as a capital gain, and you would have to report taxes on that. That's just how that would work out. You're selling an asset, there's a gain, you have to report it as a capital gain, you have to pay taxes on it. When you die, that gain disappears in its entirety. Okay? So your beneficiaries would then be able to turn around and sell ExxonMobil at $100 a share, assuming that was still the same trading price, and they would have zero of a capital gain to report. That's the rules as they stand now, and that's the rules as they have been for many, many years. Similarly, if along the way your ExxonMobil is going from $10 to $100, you don't have to pay any tax along the way on that unless you sell it. We'll go to a break, and then when we get back from the break, we will recap sort of where we are on the current law, and then where we are on the proposals that are out there in terms of the Democratic Party. So stay tuned for that here on Dollars and Cents. This is News Radio 93.1 WFLA. This is Joel Garris, Nelson Financial Planning. You're listening to Dollars and Cents. So welcome back, ladies and gentlemen. We're talking a little bit here on Dollars and Cents with me, your host, Joel Garris of Nelson Financial Planning. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents here on News Radio 93.1 WFLA. Hey, folks, welcome back to the program. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents, broadcasting live on Sunday mornings on 93.1 WFLA. News Radio 93.1 WFLA, and simulcasting over there on 540 AM. Living in perpetuity on the internet, so we've got not just the audio of the program in a podcast file on your favorite podcast channel, whether that be iTunes, Google, Facebook, and the like, but also on a video as well, full-length video on YouTube, along with sort of a summary that we'll be putting up on Facebook as well. So when we reference stuff here on the program, and for our audio listeners and for our radio listeners, what we'll do is we will make an effort to post it on Facebook so that you can see kind of the articles that we're referencing, and certainly see some of the charts that we may be referencing as well. So we'll certainly put a link to that Wall Street Journal article talking about some of those categories and differences of some of the proposals that are floating around as the candidates start to formulate more specific plans for what their agendas or platforms look like. I think one of the biggest issues out there that nobody seems to be talking about are the programs of Social Security, Medicare, Medicaid. Haven't heard anybody talk about that and the massive deficit that's running up. Perhaps that's too sensitive of a topic for politicians to talk about. Our commentary would be the longer you wait to solve a imbalance, the harder the solution is going to be. So hopefully the politicians in Washington will get on with the topic at hand, because those two programs in particular are not trending in the right direction. So this segment of the program, we thought we would talk a little bit about some things that you can do to get your life trending in the right direction. Some of the things that you can do to save money to make not just this year a better year, but also your years in the future. And so any list about things that you should be saving for sort of starts from retirement. Obviously, that's probably first on the list, is if you want to have a better future, then certainly saving more for retirement and setting aside money for retirement is probably the very top of that list. But certainly there are other things to want to save money for as well, and we thought we would chat a little bit about them here on this segment of the program. So beyond just saving for retirement, which is what you typically often hear about in conversation, there are other things that you want to also be putting money away for. And for example, having an emergency fund or having a reserve account is certainly one of those things that you also want to be putting money away for on a regular basis. So it's important to, as you're thinking about your cash flow, to make sure that you are establishing an emergency savings type of fund. Why? Well, because you never know when those emergencies are going to come up, whether it be a car repair or a home repair or anything along those lines. Then having an emergency savings account certainly helps to address when you need that cash, so that you're not going and hitting a credit card or something like that, and then having to pay for that over a much longer period of time, and having to pay a pretty high interest rate on that. So that's the concept of one of those things that you can be saving money for as well. Another thing would be also putting money away for those larger recurring expenses. And for that, we're thinking about things like maybe your homeowner's insurance policy or maybe your real estate taxes. Now, many of you that have a mortgage already do that on a monthly basis as part of your mortgage payment. But for most folks that don't have a mortgage, or perhaps their mortgage company doesn't require them to escrow taxes and insurance, then the reality is that you wind up getting hit with that bill all at once. And so it's important, particularly right now, when you're starting to see those real estate tax proposals come in your mail, that means you've got a pretty good sized payment due sometime in the next few months. And so saving money along the way to have a separate account, and we're not talking about an emergency savings account, we're talking really more about a recurring expense type of an account where each and every month you're sort of saving for that along the way because you know that those are recurring expenses. Recurring expense isn't an emergency. Your real estate tax bill that is coming in the mail in the next month or so shouldn't be an emergency. That's something that happens each and every year when you own real estate. So one of the things that you can do to help improve your overall financial situation is to save money along the way so that when those bigger recurring expenses come in, then in fact, you've got the money set aside to help pay those types of expenses. Other types of reasons to save money are to help pay off debt. Chief among the debt in America today is student loan debt and credit card debt. Being able to save money, putting money away or putting money towards those types of credit card debt or student loan debt to try and help get them accelerated, so to get them eliminated as soon as possible, is certainly a very good way in which to save money, and certainly important to save money to get those eliminated, along with having a housing fund. That's always a good idea as well. You never know when just general home repairs are going to come up, particularly like this weekend when you've got a hurricane bearing down on us. Then you may want to have some money set aside for those other housing types of expenses. In terms of other ideas and things to put away money for, certainly that list would have to include health-related expenses as well. Now, oftentimes, if you've got a decent enough health insurance policy, then that may only be a deductible, but still putting aside money each and every month on a regular basis to make sure that you can cover those deductibles, again, so it's not hitting the credit card. But more importantly, are some of those bigger issues that people don't think about when it comes to your health. Your health also, of course, would include things like dental and vision. And certainly there are some dental insurance and vision insurance, but those aren't as common as health insurance. So you also want to be putting money away and saving money for things like a potential dental issue, or perhaps needing new glasses or contacts or those types of things. So there's really a host of things that you should be putting money aside for besides just retirement. The reality is I think we think, oh, I need to put money away for retirement, and that's what I need to focus on primarily. There's also a lot of other things that you would want to also be putting money away for on a regular basis, ranging from an emergency savings account, college savings as well. Forgot to mention that one earlier. But things like an emergency savings account, things like a home and a housing account, things like paying off credit card debt and student loan debt. All of those are important to be saving and putting money away for. So make sure to think about that when you're looking at your cash flow and looking at where to save money. There's more than just retirement in order to have your finances in as good a shape. Well, the music means we got to wrap it up and get on out of here. So we will do that. Thank you all for listening to the program. And you've been listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.